Have you ever wanted to create a stream of income that not only competes with, but potentially surpasses your full-time job? It's every investor's wish, but most people never know how. But if you've been looking into high-yield dividends, you're probably on the right track. And to get you even closer to that goal, in today's video, we'll be looking at the high-yield dividends wheel strategy, an innovative approach to investing that promises to significantly increase your dividend income at an accelerated pace. This strategy revolves around a meticulous selection and timing of investments in high-yielding dividend exchange-traded funds and stocks, capitalizing on the compound effects of reinvesting dividends in a cyclical manner. So, how does it work? And how profitable is it? Well, let's see. Understanding the dividend wheel strategy. At its core, the dividend wheel strategy is an investment plan that allows you to harness the full power of dividends, turning them into a huge source of income. The dividend wheel strategy involves a cyclical process of buying, holding, and selling dividend-paying securities to take advantage of their payout schedules. The essence of the dividend wheel strategy is its focus on the rotation of funds among a high selection of dividend-paying assets. You start by purchasing shares of a high-yield ETF or stock shortly before its ex-dividend date, the crucial cutoff point after which new buyers are no longer entitled to the upcoming dividend. By entering just in time, you earn the right to the next payout, setting the stage for the first spin of the wheel. Timing is everything in this strategy, requiring meticulous planning and execution. Buying before the ex-dividend date ensures that you are eligible for the dividend, while selling after receiving the dividend allows you to reallocate capital towards the next opportunity. This cycle repeats across different securities, each chosen for their payout dates, ensuring a consistent flow of income. This systematic approach leverages the predictable nature of dividends, turning the calendar into a tool for strategic investment. The choice of when to sell is as crucial as the buying decision. While the strategy emphasizes selling after the dividend payment, the exact timing may vary based on market conditions and your objectives. Some may opt to sell immediately after receiving dividends to quickly reinvest in other opportunities, while others might wait for favorable market conditions to maximize capital gains. This flexibility allows you to adapt the strategy to suit your risk tolerance and income goals. Then comes reinvestment. This is the strategy's powerhouse, fueling the wheel's momentum. Each dividend received is not merely pocketed, but reinvested into another dividend-paying asset approaching its ex-dividend date. This reinvestment amplifies the compounding effect, gradually building your portfolio and income potential. Over time, even small initial investments can grow significantly, illustrating the power of compounding dividends. Despite its potential for generating regular income, the dividend wheel strategy requires you to be vigilant and disciplined. The markets are dynamic, and dividend policies can change. Regular monitoring and analysis are essential to navigate this evolving landscape and make informed decisions. By staying informed and adapting to market changes, you can continue to spin the dividend wheel effectively, reaping the rewards of a well-executed strategy. Now, what makes an ETF the perfect candidate for the high-yield dividend wheel strategy? The answer lies in understanding the unique characteristics of high-yielding dividend ETFs. These funds are designed to aggregate stocks that distribute higher than average dividends, providing you with a steady income stream. The allure of these ETFs is the ability to offer both the growth potential of stock investments and the income reliability of bonds. By focusing on high-yield dividend ETFs, you can tap into sectors and industries known for their robust dividend payments, such as utilities, real estate, and energy. A prime example of where to start in the selection process is with the Defiance ETFs. These funds are known for their strategic focus on high-yield dividends, offering you a gateway into specialized markets with the potential for substantial payouts. Defiance ETFs are structured to capitalize on sectors and innovations poised for growth, such as technology and healthcare, without sacrificing dividend yield. Their selection criteria ensures that not only companies with strong dividend-paying history and financial stability are included, making them an excellent starting point for building the dividend wheel. However, the criteria for selecting the right ETF goes beyond just the dividend yield. While a high yield is enticing, evaluating the sustainability of these payments is crucial. This involves looking into the fund's underlying assets, payout ratio, and the economic health of the sectors it invests in. An ETF with a high yield but shaky foundation may not sustain its payouts in the long term, which could disrupt the dividend wheel strategy. Therefore, carefully analyzing an ETF's fundamentals before including it in the wheel is imperative. Payout dates are another crucial factor in the selection process. The dividend wheel strategy relies on a continuous flow of income, necessitating ETFs with staggered payout dates. This ensures that there is always an upcoming dividend to reinvest, keeping the wheel spinning. You should map out the ex-dividend, record, and payout dates of potential ETFs to create a calendar of income. This calendar guides the reinvestment process, helping to identify when funds will be available to move into the next investment. Strategic positioning within the wheel is about aligning ETFs to optimize income and minimize downtime between payouts. This requires a portfolio of ETFs that not only covers each month of the year, but also considers the sequence of payouts. Ideally, each ETF's dividend should fund the purchase of the next ETF in line before its ex-dividend date, ensuring eligibility for its dividend. This sequential planning is crucial for maintaining the momentum of income generation. Diversification within the dividend wheel is also paramount. Selecting ETFs across different sectors and industries can mitigate risk and enhance the stability of dividend income. For instance, while technology ETFs may offer high growth potential, including utilities or consumer goods, ETFs can provide stability during market volatility. A well-diversified wheel leverages the strengths of various sectors, balancing growth and income stability. Another thing is being mindful of the ongoing monitoring and adjustment of the ETF selection. The dividend wheel strategy is not a set-and-forget approach. It requires active management to adapt to changing market conditions and dividend policies. Regularly reviewing the performance, yields, and stability of chosen ETFs ensures that the strategy remains effective and responsive to opportunities for optimization. You must be willing and ready to replace underperforming ETFs with more promising candidates to sustain and grow your dividend income effectively. Now, let's break down the process of setting the dividend wheel in motion step by step. The first step in this journey begins with investing in Defiance ETFs, which are known for their initial high dividend payments. These ETFs focus on sectors with growth potential yet stable dividend payouts, serve as the foundation of the dividend wheel. By investing in Defiance ETFs, you secure a position to receive your first set of dividends, setting the wheel into motion. Once the dividends from Defiance ETFs are received, the strategy dictates rolling over these dividends into high-yielding individual stock ETFs, such as those associated with NVIDIA. This step is crucial as it leverages the growth potential of specific stocks within the technology sector, known for their robust dividend yields. Investing dividends into such ETFs not only diversifies your investment portfolio, but also aims to increase the dividend yield from the amount initially invested in Defiance ETFs. This transition is a key move in the strategy, aiming to compound the dividend income by targeting stocks with a high yield and growth potential. The third step involves moving the dividends accumulated from the high-yielding individual stock ETFs into yieldmax ETFs. These ETFs are specifically designed for mid-month payouts, ensuring that the income stream continues without interruption. Yieldmax ETFs often comprise a mix of assets optimized for yield, providing a strategic balance between risk and return. This stage is crucial for maintaining the momentum of the dividend wheel, as it ensures that the dividends are continuously reinvested into assets that generate income at different times of the month. The final step in executing the dividend wheel strategy is the rollover into end-of-month paying ETFs like FE and CLIP. This move is designed to capture the last dividend payouts of the month, completing the income cycle for that period. ETFs like FE and CLIP are chosen for their stable dividend yield and payout schedules that align with the end of the month, making them ideal for this phase of the strategy. This systematic rollover from one set of ETFs to another, timed perfectly with the dividend payouts, ensures a consistent flow of income throughout the month. After this, how can you ensure that your dividend wheel strategy maintains its momentum and maximizes return over time? To maximize returns, you have to effectively leverage dividend payouts for reinvestment. By reinvesting dividends into other high-yielding assets, you can compound your earnings, exponentially increasing your investment's value over time. This method transforms modest initial dividends into a significant source of income, illustrating the power of compounding and the importance of reinvestment into maximizing returns. To understand the potential earnings and growth over time, you must become adept at calculating and projecting your dividend income. This involves considering the yield of each asset within the wheel, the timing of dividend payouts, and the reinvestment strategy. By modeling these factors, you can estimate your monthly and annual dividend income, accounting for the compound growth effect of reinvesting dividends. Such calculations reveal the strategy's long-term potential, showing how even small increases in dividend yield or more efficient timing can significantly impact your overall returns. Also note that adjustments and optimizations are crucial for enhancing the dividend wheel strategy's effectiveness and maximizing monthly income. This might involve reallocating investments to ETFs with higher yields or adjusting the timing of purchases to optimize eligibility for dividend payouts. You can also consider the tax implications of your investment choices, as taxes can significantly affect net returns. Regularly reviewing and adjusting the strategy to incorporate these factors ensure that your approach remains aligned with your income goals and market conditions. Diversification across different sectors and types of dividend-paying assets is another critical factor in maximizing returns. While the strategy focuses on ETFs, incorporating individual stocks with strong dividend histories or real estate investment trusts, REITs, can provide additional income streams and reduce risk. Diversification ensures that your income does not rely too heavily on a single asset or sector, which could be vulnerable to market fluctuations or sector-specific downturns. The use of dividend growth stocks, or ETFs, focusing on companies with a history of increasing their dividends, can further enhance returns. These assets offer the dual benefit of potential capital appreciation and increasing dividend payouts, contributing to the strategy's growth potential. By prioritizing investments in assets likely to increase dividends, you can accelerate the compounding effect, leading to greater income growth over time. And that's it. So, how do you feel about embarking on this financial journey using the high-yield dividend wheel strategy? Intrigued by the potential of this strategy? We'd love to hear your thoughts, so please drop a comment below. Don't forget to like this video and hit the subscribe button for more insightful strategies like this one.